Welcome to Chain Bureau, smart crypto insights for smart investors. So today, we're going to talk about something huge that's happening right under our noses. You see, traditional finance, they're not just dipping their toes in crypto anymore, they're actually building their own version of a digital dollar right on the blockchain. So what in the world are deposit tokens, and why is Wall Street all of a sudden so into this? Let's dive in.
Now look, this isn't just some crypto pipe dream. When the CEO of BlackRock, we're talking the world's biggest asset manager, says the future is tokenization, you know a massive shift is coming. This quote, it just sets the stage perfectly for what we're about to unpack. A future where pretty much every financial asset, from your stocks to your bonds, could end up living on a blockchain. But for that tokenized future to actually work, you need one absolutely critical piece of the puzzle: a stable, trustworthy form of digital cash to settle all those token trades. And frankly, that's been the big sticking point for all the major institutions.
Now, for years, stablecoins have tried to be that solution, right? They've acted as the cash of the crypto world. But for the big players, the massive banks and the giant asset managers, stablecoins just bring a whole new basket of risks that make them, well, really nervous about going all in.
And this slide, wow, it really lays out what keeps those bankers up at night. You've got the terror of a stablecoin losing its one-to-one peg with the dollar. You have the bank run scenario where everybody panics and tries to cash out at the same time. And then there's contagion, the fear that one bad stablecoin could bring down the whole system. The bottom line is, for these institutions, the current solution just isn't safe enough for prime time.
So, if stablecoins are a no-go for Wall Street, what's the play? Well, it turns out the solution is coming from inside the house. The banking industry is building its very own alternative, one that's designed from the ground up to work inside their super-regulated world.
And that solution is the deposit token. Okay, let's break this down because this is super important. A deposit token is not some new kind of money. It's just a digital stand-in, a token for the same old commercial bank money that's already in your account. Legally, economically, it's the exact same stuff. It's just been put into a new, high-tech blockchain wrapper. So how does this actually work in practice? It's this really cool hybrid of the old world and the new. When Company A wants to pay Company B on-chain, their bank just takes the money out of their normal account. But instead of some slow, clunky wire transfer, it instantly updates the blockchain, zipping the deposit tokens over to Company B's wallet. The settlement is immediate, what the pros call atomic. This is a total game changer, because it means money isn't stuck in transit for days, and the risk of a trade going wrong just evaporates. And listen, this isn't just a concept on some PowerPoint slide. JP Morgan, through their Project Guardian work with Singapore's central bank, has already run successful tests. They've used this exact tech for really complex stuff like foreign exchange and trading government bonds, and they proved it works in the real world, right on a public blockchain. You know, seeing these kinds of massive institutional moves is exactly why staying ahead of the market is just so crucial. For our viewers who use technical analysis, having the right tools can make all the difference. We've actually got a link in the bio to some powerful trading indicators that are designed to predict market moves with high accuracy, and they work on any device. It's definitely something to check out if that's part of your strategy. Okay, so we have stablecoins, we've got these new deposit tokens, and then we always hear people talking about central bank digital currencies, or CBDCs. To really get a handle on this, we need to put them all side by side and see how they stack up.
This chart is incredibly helpful. The most important thing to look at is who issues the money. Deposit tokens, they come from commercial banks like JP Morgan. Stablecoins are from private companies that aren't banks, and CBDCs would come straight from a central bank like the Fed. That one difference changes everything else, from how they're regulated to what kind of protections you get. Deposit tokens just slide right into the existing banking system, and they come with things like deposit insurance.
So let's get even more concrete. JP Morgan has already gone way beyond just pilots. They've launched a live, real-world product that puts this entire theory into practice today.
And they are not starting small. They kicked off their new tokenized fund with $100 million. Of their own money. That's not just a test, that is a serious statement of intent.
So this is it, JP Morgan's MONY Fund. And the fact that it runs on the public Ethereum blockchain is a massive deal. It basically works like a normal, boring money market fund, investing in super safe US treasuries. But here's the crazy part. Qualified investors can buy in with regular old cash, or even with the stablecoin USDC, and in return, they get tokenized shares of the fund sent right to their crypto wallet.
So, what's the real advantage? Why does this matter? Well, for a big investor, this means they could cash out their shares on a Friday night, or they could instantly use those tokenized shares as collateral in a DeFi lending protocol over the weekend. These are things that are just impossible in the traditional 9 to 5, Monday to Friday financial world. It completely unlocks capital and creates brand new ways to use it. This fusion of traditional, stable assets with the 24/7 speed of the blockchain is creating entirely new market dynamics. And if you're looking to capitalize on these shifts, just remember that link in our bio gives you access to trading indicators that also work around the clock, with win rates that are reported up to 93%.
So what does it mean when the biggest banks in the world start building real products on public blockchains like Ethereum? Does this spell the end for the permissionless decentralized finance that we all know as DeFi? Or is this the start of something totally new?
I love this quote from a longtime crypto user on Reddit because it just perfectly captures the change in thinking that's happening. The big realization is that Ethereum's greatest value might not be to replace money, but to act as the neutral global plumbing that connects the traditional dollar system to everything else. JP Morgan building on Ethereum is like the ultimate proof of that idea. What we're witnessing is the line between traditional finance and DeFi just blurring, creating this new hybrid system. This is where the opportunities of the next decade are probably going to be found, and navigating it is going to take sharp insights and, for a lot of us, some really sharp tools. So as a final reminder, those powerful trading indicators we mentioned are available through the link in our bio.
And this brings us to the final, really mind-bending question. What we're seeing with deposit tokens in these tokenized funds, it isn't just a niche product for big institutions, it's a blueprint for the future of all money. The technology is being built and tested right now that could one day mean your regular checking account is no longer just a number in a bank's private database, but a token in your own digital wallet. Just think about that for a second.